can help you get lower rates on insurance. It can help you maybe get into that apartment that you want. Or maybe that dream job you wanted. Yeah, employers do check credit. Do you know why? It's because it shows the risk. Now, granted, you may not have any credit at all, and that's not always a good thing. You want to have a credit score. We're going to talk about what makes up a good credit score. But you do want to understand what a credit score is and what makes it up and why you need to have it.
I love that. I'm going to give you guys an example. Sherry's got a great credit score. She's credit score is over 800. Fantastic. Susan, not so much. My credit score had some challenges. It's probably about 550. We both are buying a car. Who do you think is going to have a better experience at the bank? Sherry at a high credit score or Susan at a low credit score? Who thinks it's going to be Sherry? Who thinks it's going to be Susan? Who thinks it's going to be both of us? So there's the trick about credit scores. Banks, your car dealers, they call them economic guys, they're going to treat you all the same. But here's the cost of it over a life of a loan. So let's look at that car loan at somebody who's got a good credit score of anything over 740 in the green. Over the life of the loan from an interest perspective, they're paying about $3,600. Susan, on the other hand, is going to be double the amount, right? We're still going to have the same sort of experience. They're going to treat me just the same way. But Susan, who's really probably cash-strapped anyways, is going to be paying twice as much on interest, and it goes back to risk. I'm a riskier client. With my credit score being a little lower, I'm more likely to default. At least that's what the models say. And so banks are trying to manage risk. That's everything about it. So it has nothing to do with experience. If you ever shop to payday lenders, they're not here in the state of Illinois. They're slick, and they have great customer service. But here's where the real cost. So we're going to talk a little bit about, this is why you should care. And now, Sherry, I'm going to give it to you to talk a little bit about the FICO scoring model.
So the FICO scoring model is the scoring model that most financial institutions will use when you're applying for credit. You are probably all familiar with Credit Karma, right? Most of you probably use that to check your credit scores. It uses a Vantage scoring model. We're not going to talk about that today, but I'm going to tell you it's still a good, valid way to understand your credit score and your credit. It's just you see the FICO has these 5 main components, and Advantage has 6 ways that they break up the way they look at your credit. So it changes. So you may be following your credit score on Credit Karma, and you apply for a loan, and you come into the credit union, and we tell you, well, your score is this, and you're like, oh, I thought it was this. That's the difference. They're both valid. It's just your financial institution is looking at FICO. So ways to keep your credit up. Your payment history is 35% of your credit score. What does this mean? This means if you are making your payments on time every time, you have a great opportunity to have a good score because it's 35% of your score. If you miss a payment or you're late on a payment, that will cause your score to dip.
And like super fast.
Really fast, and it stays on your report for 7 years. 7 years, long time.
So here's the thing, to build good credit, hard, takes time. To hurt your credit, just like that. So that's the reason why we like making all your payments automated. So when life happens and you don't have a date with your money, you at least know your minimum payments are being taken care of.
Absolutely. 30% is the amount of money you owe. So when we were talking about credit cards earlier, using less than or right at 30% of your available balance, okay? And we had a question earlier, is that cumulative? If you have several revolving accounts, yes. So it's, say you have 3 credit cards with $1,000 availability, you've got $3,000 available, you only want to be using 30% of that total availability.
or less.
Or less.
And I will tell you, and those of you that are monitoring, if you're with the credit union, we have a Vantage scoring model. We'll show you the different ways that your credit is being impacted by choices you're making and kind of giving you your own virtual coach. But I'm going to share something I've noticed. I actually think as you get closer, you're 15%, 20% of that available credit that you're using, I'm already starting to see some benefits happening. So you really don't even want to get close to 30%. You really want to stay within 10 to 15% of your available balance. And to Sherry's point, it's cumulative. And if you notice, the two biggest things that impact your credit score are two areas you have direct control over.
Yeah, there's 65% of your score right there that you can control. Yes, question.
In your credit utilization.
The financial institution or whoever owns that plastic, money. So when you don't transact, they're not making money on it or even any of the interest, they may close your account for inactivity. Right. So I do say you never want to close any of your accounts. And some of those are at zero balance, just put gas, fill it up with gas, and then just pay it off. And at least you're using it. You don't have to worry about your financial institution closing that off. I will tell you, there is an area that is out of your control. Length of credit in your control. So if you don't have any credit, it's a good opportunity to consider doing that sooner than later to start building it. It's the new credit. Sometimes when you have to buy a house or a car or getting another credit card, you take a bit of a hit when your credit score gets pulled, and that's unfortunate, but that does happen. We do know that consumers, when you're car shopping, you want to shop a variety of institutions to make sure that you have the best credit score. So you've got 30 days to shop the market, and it will only count as one pull, and that's the same for a mortgage as well.
Yes, good point, good point.
Did we answer your question?
Where do you calculate it yourself?
Yeah, and you do calculate it yourself. And here's the other thing you have to be mindful of. I wish all of our all of our creditors reported our balance on the same day of the month. I would love that. That's not how it works. So you can have a zero balance by day 30, but your credit card may be sharing your information when you actually had a balance at day 15. What I like about Experian or TransUnion or like banking with us, it will tell you, oh, it looks like you paid off your credit card. Be mindful of that because that's telling you when that credit card shared your information. So that's where you can get a little sideways about using under that 30% mark, is knowing when that creditor is sharing that information. And again, it's designed, every creditor does not have to report on one specific day, it's on them. So that's as you, the consumer, to have that awareness, to be managing that. See all the things you have to manage? That's one more little thing. Yes?
Does your credit history only start when you actually get a credit card? Or say you start with a debit card and transitioning to a credit card, is your history still being built from your purchasing when you had a debit card?
No, unfortunately, financial institutions don't report debit card usage or checking account, or we call them spend accounts now because nobody knows what a checking account is, nobody knows what a check is, right? We use debit cards. So your credit history is built when you get that first loan, get that first credit card. And it's really important to understand this is starting that. I hate to say start your credit usage early, but really it's building that credit history earlier in life so that in later life, when you're ready to buy your first home or your first vehicle, get that first auto loan, you have the credit history that the financial institution needs, because having no credit will hurt you as well. And a good financial institution, though, will have a way for you to build that credit. So we at U of I Credit Union, we have a couple of ways to help you build your credit, and happy to talk to anybody about that offline if you're interested in learning about those resources. Yeah.
So we just talked a lot about credit scores. That was a lot of information. We're going to share our contact information if you guys have anything specific. There's a lot of reels on it. Some of them can be trusted. Some of them are kind of sketch. So one of the things, not just our credit union, but every single credit union, we are really mandated to just give you guys honest information. That's kind of who we are. Most of us are financial coaches too, so we'll do that for you. I love U of I, obviously, right here, but other credit unions do this too. So I just want you to know that when you leave, there's always a resource at your local credit unions. Now, we talked a little bit about fraud and ways that you can protect yourself. So we're going to change the subject a little bit, and I'm going to talk to you about annualcreditreport.com.
Hey, Susan, I'm sorry to interrupt. Before we do that, we had a question over here.
Or somebody, please. Are we going back to credit scores?
So yeah, kind of more about how we can start building your credit as a college student. So what we can go way of going about doing that. Typically, it's pick up a credit card of some form. What should we be looking for? Should we, is there certain terms that we should be aware of? Things like that.
Yeah, avoid any credit cards that have rewards or cash back tied to them. They're going to carry a lower interest rate. And there's time for you to get into those other higher. The reason why I say that is because if you get a credit card and you're just getting started, but you're not in a position to maybe, if you use it and you can't pay it off every month, then a lower interest card is your best friend, right? Because you're going to pay under what interest rate you get if you're going to pay it off every month. Because that's the best and fastest way to grow your credit is to use your credit card and pay it off every month. The other is getting an installment loan. So credit has two components: revolving credit, which are your credit cards. They never end. They always have you can always use them. And installment credit. Installment credit is a closed-end loan like a vehicle or a personal loan. So that's two ways to build your credit. But remember, credit cards, the best way to build your credit is use it, pay it off every month. Use it and pay it off every month. Does that answer your question?
And you're probably seeing a lot of mail, so just shop the market. Shop your credit unions, shop local institutions, shop the big ones, and kind of see who's offering the very best interest rate. As students, you're going to see a lot of inducements because they know your earning power, especially coming out of the University of Illinois, is high. So they're going to try to have a relationship with you sooner than later. Yes?
If you are only using 10% of your credit, but you have like a lot of credit with multiple cards, is that also bad?
No, that's good.
No, that's
Because it's cumulative.
So is it bad to have like, is there a harm in opening more credit?
It's the only problem that's going to happen is that new credit. So every time you open up a new credit card or a new loan, they have to check your credit, and you'll take a little hit, about a 10% hit, yes and no, and that goes away within several months. But that's what you have to be mindful of, is that every time you're asking for a new line of credit, you're pulling your credit score, and oftentimes it's the new credit that hits to your credit score that's dragging down the numbers. So just be mindful of that. It's temporary, but it lasts anywhere up to 6 months. So it's temporary, but it can make a difference, especially in those 6 months, if you're planning on doing a capital purchase. There's a question over here.
How many credit cards do you have?
That's personal,
It is personal.
and that depends.
And it does depend. I would say don't go out there and start applying for a bunch of credit cards, okay?
Makes people very nervous.
It makes lenders very, very nervous when you do that. The other is, if you do that and you're doing it because you want to build up your available balance, my suggestion would be have two credit cards that you like. Use them for a little bit, and then go to the lender and ask for an increase in your available balance. Doesn't mean you have to use it, but what it does then, it increases your utilization, which then will also improve your score because then it lowers how much you're using. So that 10% may become 5%, right?
Yeah, I mean, I think you guys want to remember, it's not about volume, it's about quality. So if you have one credit card and you're maintaining your payment history, you kept your balance, you're using it maybe to eat out, you're paying it off, and you're having it for a length of time, that's actually going to build your credit score a lot better than quantity of credit cards.
Yeah.
So that's, and the other warning I want to give all of you is most banks will give you a 30-day cycle. If you get a store account, like an Abercrombie account or like a Macy's, sometimes those, it's not a 30-day cycle, it's a 20-day cycle, and it's legal, they can do that, because they're trying to get you with interest faster, and you'll notice that those store accounts, although they're attractive at the moment, because they're going to give you 20% off. I know that's a lot. But be aware that those lendings are all designed to separate from your money, and that your cycle could be lower, and your interest rates generally are much higher. There was another question back there, and then we're going to move on. Know that we'll stay, so if anybody wants to talk further about credit score, we'd love it. You guys can stay later with us. One more question before we move on.
I just wanted to say I really appreciate all of you measures in order to keep your financial life healthy. But I wanted to know all the different savings in different ways in which you can save. Because I know more or less think of like savings accounts for could you maybe speak on like investments accounts or different accounts of which you can put your savings into?
So,
you want to
yeah.
share our point of view on this?
yeah, so there's a few things. One, high yield savings accounts are a really good option right now because they are making some good money. If you have $1,000 or more, I would suggest a certificate of deposit is a good safe way to put your money into a different type of high yield savings, earning a little bit more money. Investment accounts. Here's, as a financial coach, here's what I tell all my coaching clients. I suggest you not start investing until you have an emergency savings set aside. And by that, you have to be able to cover, ideally, about 3 months worth of expenses.
And that's your needs, not
Right.
your wants,
Right.
not your savings, just your needs.
Just your needs. So that's not 3 months of income, that's 3 months of needs expenses. The reason why I say that is when you start investing your money and you don't have your emergency savings set aside and you have an emergency, what are you going to do? A lot of people will go to their their advisor and say, well, I need to withdraw this money because I have an emergency. Did you know it's going to cost you to withdraw that money? It's going to cost you then, and it's going to cost you at the end of the year.
That's right.
If you have an emergency savings, you can pull from that. The other is if you don't want to go from your investments, then you're going to a credit card or a loan. So have your emergency savings set up. I can give you some additional resources offline. Talk to you about some high yield opportunities and things like that. Because I know we're running short on time.
We're getting close, but I do want to talk about when you have your big kids jobs. I'm using Nolan's here as their example, I like their terminology. And they're maxing out what their employers matches. So they're saving in their retirement what they need to save in order to get that employer match. And I will say, remember this, that's your goal too. Because that's just free money.
Right.
And so if you're putting in 6% and they're going to match you at 6%, that's 12% of your income that starts to compound at a young age, and that gets you on the road to retiring at 45 or 55.
Absolutely.
All right, so now let's talk about annualcreditreport.com. Guys, do this. Take a picture of this.
Write this down.
This is
Write
where
it
you
down.
want to go, and you want to do this like sooner than later. You literally can pull all your credit information from TransUnion, Equifax, and Experian. And you want to know today to make sure there's nothing fraudulent on there. And that's going to show you. So if there's an account that's on there that does not look familiar, you're going to want to dispute that. And this is something that's going to help protect you. If you want to put I'm going to talk about a freeze, but what's the one that's less than a freeze? Oh, you can put a monitoring on your accounts.
Yeah, you can do monitoring,
You can do
yes.
monitoring on all 3 of those bureaus so that if you pull credit, like if you're applying for something or if somebody else is trying to pull credit in your name, you're gonna get an alert. Or you can go really aggressive, which is I've had to do because I've had a lot of people trying to use my credit for bad things. I have a freeze on my account, which basically means I can't go buy a card today because they're gonna want to pull credit. I'm gonna have to put a release on that. It's gonna take me 3 days to put that hold on there. But here's the peace of mind I now have is no one can get credit in my name. I can't even get credit in my name. So it's gonna make it a little inconvenient for me. It takes 3 to 4 days to get that hold removed, but I think it's worth it from a peace of mind perspective. Yes?
It's also worth noting that all credit unions are like legally obliged to give you a freeze for free. They have a second one called lock, which is paid. You don't need to pay money, but for the freeze.
Well, and this is free too. This is run by the federal government.
Yeah, this is free.
This is free. This is actually
Everything
ran
on
by the
this,
federal government.
yeah, everything on this website is free to
Yeah, this is
you.
completely
Yeah,
free.
yeah, but like specifically freezing your account. Like if you go to the agency's websites, they will have a button saying, "Oh, lock your credit, pay this much." But then there's
So this is free to lock your credit.
okay.
Yeah,
Yeah.
you will not have to pay this. It'll take you straight to TransUnion. There are a lot of companies that try to slide in and say, I'll do it for you. That's where you're gonna get paid. You'll have to pay for that. If you go to annualcreditreport.com, and this is what the URL looks like. It is ran by the federal government, and it is the only free way that gives you this type of access. All right, any other questions about annualcreditreport.com? We're almost done, guys. Y'all have done such a great job. All right, we're gonna keep going. All right, do you credit union? So here it is. Sherry, you wanna kind of take it from here?
Well,
Close it out.
you know, here's the reason why you want to belong to a credit union. Credit unions are here for you. We're not here for the big spenders. We're not here for the big savers. We're here for you, everyday working class people. Okay? We provide full service just like any bank. We have high yield savings accounts. We've got CDs. Better yet, we've got better rates. We've got better rates on savings and loans. And why can we do this? Because banks have paid shareholders. Banks have paid board of directors. If you bank with a credit union, you are the shareholder. And we pay you back in the form of better rates on savings and better rates on loans. We also have a volunteer board of directors made up of community members right here in our community who are like-minded and have a vested interest in your financial well-being. This is why we're here today, because credit unions want to make a difference in our communities.
And so I'll also share that we're protected up to $250,000, just like the EIC, but it's NCUA. The reason why I'm sharing this, and I love U of I Community Credit Union, but we are actually a financial cooperative. So we actually collaborate with credit unions all across the country. You're going to find we all show up the exact same way. Here's the challenge that credit unions have. Most consumers have heard of them, they just don't think they can join. And pretty much anywhere you go, you're going to find a credit union that you can partner with and just have that awareness that they're there for you. This is our digital banking. It's number one in the area. It can do all the things. Most banks today can also do the same functionality. I actually think ours rivals some of the very big banks. We're making enhancements on a regular basis, and it matters in our community because of our tech. We integrate financial wellness into everything we do. You will also be able to do your financial wellness scoring, and some of your information is right there. You'll see tips and tricks, and they'll be telling you some coaching that's there. So again, financial education is just that important to all of us. I just buzzed through that really fast. Any other questions before we close this out? Oh my gosh, you guys have been great. So give yourself a round of applause. Thank you so much.